where I've got to start with this is how I f***ed it up. You see, I f***ed it up many ways. Crypto is a complicated asset class. It's hugely volatile. It does the unexpected. Even though people think the cycles repeat normally, they don't. They're all different texture, context, and it's really easy to f*** it up. So let's do the honest approach, because I really f***ed it up.
For years, Raoul Pal has been one of the loudest voices arguing that crypto is following a long-term adoption curve, unlike anything traditional finance has ever seen. His now famous banana zone thesis captivated investors by suggesting that once liquidity conditions aligned, digital assets could enter a period of explosive upside driven by network adoption, capital flows, and accelerating participation. But as many investors discovered over the past cycle, markets rarely unfold exactly as expected. Timelines shift, narratives evolve, and even the strongest conviction can be tested when price action refuses to cooperate. That reality is what makes this latest message from Raoul Pal so interesting. Instead of focusing on price targets, cycle predictions, or the next catalyst for crypto, Pal begins with something much more personal. Looking back over more than a decade in digital assets, he openly reflects on the mistakes he made, the opportunities he missed, and the lessons that ultimately mattered far more than any short-term market call. It's a surprisingly honest assessment from someone who has lived through nearly every major phase of Bitcoin's journey. And according to Pal, the biggest threat to long-term success in crypto isn't market volatility, regulation, or even bear markets. It's the tendency for investors to get in their own way. In this video, he will explain how he turned one of the greatest investment opportunities of the modern era into a far less successful outcome than it could have been, and what that experience taught him about surviving and thriving in crypto over the long run. Before we jump in, if you enjoy thoughtful discussions about Bitcoin, crypto, macroeconomics, and investing strategy, please consider supporting the channel by liking this video, subscribing, and sharing it with others who are trying to navigate these markets. And let us know in the comments, do you agree with Raoul Pal's approach to crypto investing, or would you do things differently? Now, let's hear what Pal has to say.
You see, I got into crypto back in 2013. I wrote the first ever macro strategy piece about Bitcoin back then and bought Bitcoin at $200. You can see that on the chart here is I bought into this peak. It then slammed down and I was like, oh, I'm an idiot. I had a thesis though. My thesis was it's worth $200 today. I think it could be worth $1 million. And I'm going to discount myself by 90% for being a moron, which is always a good thing to do. And therefore, Bitcoin over time, over the next 10 years, is probably worth $100,000. Now, that worked out to be pretty correct. We pretty much got there. We've done that. But the journey is the story. So here's the journey. I buy at a brilliant price. It doubles or triples on me. It then collapses. And I'm like, okay, this is a long-term bet. I'll do nothing. And it did nothing for a while and then exploded in the back end of 2013. And it got up to whatever it got up to, 12. I think it actually got to 2000 if I had the open, high, low, close chart. But you can see the move that I had. I had a huge run up and then suddenly it collapsed 84%. Again, I was in it for the long run. I just said, listen, I'm going to treat this like a call option. I don't really care. And I just kind of kept it on my screen, observed it from time to time, didn't really know what drove Bitcoin, except it was going to get adopted over time and let the bet play out. So I did the right thing. I let the bet play out. And then what happened is it kept exploding. And it was like, oh my God, look at this now. Suddenly I'm looking at my screens and Bitcoin's at like $2,500. I, in fact, sold at $2,000. Why did I sell? Well, it was FUD, fear, uncertainty, and doubt. It was about the forking of Bitcoin. It was about, oh my God, it's a bubble. Now, I'd already gone through one of these bubbles, but for some reason, your mind starts with you. You start hearing the FUD. You're like, I've made a 10x. I'm a hero. Stan Druckenmiller couldn't have nailed this trade better than me. I'm amazing. So I sold at 2000. Thought, I've made a 10x. I've done a great job. Problem is that's where I sold it. It went up another 10x in the back end of 2017. I tried to pretend I didn't feel like a moron, but I did, because I could have made 10 times more money than where I'd sold. But that was okay too, because after that, it collapsed again. But when it collapsed again, it fell another 80 odd percent, but then it started rallying. And I bought back in stupidly in COVID. Stupidly, the market was down 50% in a day. I bought back in at about I layered in between 6,500 and 10,000 in Bitcoin. And I thought I'd been a genius, but I hadn't. You see, I just should have held it. But it was the trading around it, the buying, trying to sell into strength and then buy back into weakness. The problem is over time, the chart just keeps going up because it's a network adoption asset. And I was doing the wrong thing by trying to time it. So even though I bought it at a great point, if I was a newbie in 2020, it was the best time to buy. But I wasn't a newbie. I'd sold it at 2,000 and bought it back, maybe averaging at 8 or 9,000. So it was a really suboptimal thing that I thought I was doing right. And when I did the maths, I stuck in 200 grand when I first did it. That was a decent bet. I mean, really was a decent bet back in 2012. It would have been worth 100 million if I hadn't done anything. And that's the power of compounding, and also proof that I am a total idiot. I totally f***ed it up because I did this. Even though I came back in more size and everything else, that original bet and all the other things, it would have been just better to buy and hold it.
Retail traders buy crypto on exchanges. Serious investors think about structure. iTrustCapital's Crypto IRA lets your gains grow without capital gains gutting your profits. Their premium custody holds assets off exchange with institutional-grade security, and their treasury accounts give businesses and trusts crypto exposure with proper reporting and compliance. Same assets, completely different level of protection, 24/7 trading, no monthly fees, real U.S. customer support, $100 bonus when you fund through the link below. Price matters. How you hold it matters more. What makes this story so powerful is that Pal isn't describing a failed investment. Quite the opposite. He correctly identified Bitcoin's long-term potential earlier than almost anyone else. His mistake wasn't buying Bitcoin. His mistake was trying to improve upon a winning position by trading around it, reacting to fear, and second-guessing a thesis that was ultimately playing out exactly as expected. The lesson Pal draws from that experience is simple, but difficult for most investors to follow. Network adoption assets don't reward constant activity, they reward patience. The temptation to sell after large gains, chase narratives, or time every cycle often comes at the expense of the one thing that creates extraordinary returns over time: compounding. And with that foundation established, Pal now turns to what he calls the rules of engagement, the principles he believes every crypto investor should understand if they want to avoid making the same mistakes.
But then there's some rules of the game too. The rules that we need to understand. One is, this is a logarithmic asset. Using regular charts makes it look too noisy, too messy, too volatile. But when you see the trend rate of adoption over time, you can see it's beautiful. It's a thing of beauty. It's the same kind of log adoption that NASDAQ has had, Google's had, Facebook's had. In fact, all of the tech stocks have followed this path. Amazon, they're all log adoption models driven by Metcalfe's law. So once you realize that, it takes the drama out of the price charts. And I think that's very important, having that long-term view, because I think, and I'll show you over time, where this is all going. The other rules of engagement are what I call the don't this up rules. This is a volatile asset class. It's complicated. It's new. It has a bit of the Wild West about it. There's hacking, there's stuff that happens. First thing, don't use leverage. Leverage makes you look like a hero in a bull market, but suddenly you have a 50% drawdown on something happens, like what happened in October 2025, and you lose your stake at the casino. You lose your coins. Never lose control of your coins, of your tokens. This is like rule number one. Don't lose control. Don't FOMO. I know your friend is going to call you up and say, listen, you need to look at Fartcoin or whatever it may be. And, this is the best investment ever. And he's made, 10x his money and there's another 10x to make. And you start moving away from your core allocation into stupid shit. FOMOing too late doesn't work. This is a very crowd-driven asset class. The other thing is your FOMO friends or your X feed will get you to buy stuff that is disproven yet as an asset class. And those are earlier stage tokens, more speculative things, whether they're meme coins or earlier stage protocols or something that's not quite working yet. That's okay to have some of it. Have a small bag, the 10% degen bag I mentioned. That's where you can experiment and learn and try more speculative things. But please hold 3 to 5 assets as your main holdings. And I'll come on to how I think about those 3 to 5 assets. You may differ on that, but you better have the proof of why you have it. Not a hunch, not what your friend said, not because the chart looks good. You need to have proof of network adoption. Self-custody. You want to make sure that you're using a device like a ledger or you have a multi-sig wallet so people can't access your crypto in a hack. Have good wallet hygiene. Do not connect your wallets to third-party sites. Use transition wallets to move things around. Keep everything away from the internet. You don't want people to take your tokens. You don't want to leave them sloppy, leaving around. I don't really like DeFi protocols for the same reason, because they can be hacked. Never lose control of your tokens. Do that one thing and that saves you a lot. You can, I've had friends of mine who've lost a ledger for 7 years, come back and they've got, millions of dollars in it because they couldn't do anything. In fact, remember, in a brokerage house, the best performing clients they've got are dead ones because people don't do anything, which is because the long-term trend, the log regression is in your favor. And that's why you want to hold over a longer term time horizon. This is not about 3-week trades, 2-month trades. It's not about even the cycle. And I'll talk about that in a bit. It's the network adoption model, Metcalfe's law. Let it play out. Let it compound. It's really important. Zoom out, remove the noise. Try not to look at hourly charts. Try not to look at even daily charts. Try and keep your perspective long term, and it'll lower your cortisol levels and allow you to handle the stress. Remember, you're going to get 35% pullbacks 2 or 3 times a year, and you're going to get 50% pullbacks in Bitcoin, maybe once every 2 or 3 years. And there'll be definitely a bear market too. And then your smaller tokens will go down 80%. It's normal. As long as those tokens are showing network adoption over time, they should recover. They outperform in a bull market, underperform in the down cycle. But your main token holdings should be something that is provable to you that you know will have a long-term store of value. Not all of them. I mean, there's very few options actually when you look at it, and I'll come on to that in a sec. And the other thing, and I'll prove this to you, is buy the dip when you can. If you don't do that simple thing, you do not compound. The dips are the things, the big sell-offs, the 50% sell-off, you should be waiting for. You should have money saved for, because this is where you make the big bucks.
At its core, Raoul Pal's message is remarkably straightforward. Crypto is volatile, emotional, and often chaotic, but beneath all of that noise lies a much larger trend. The daily headlines, social media debates, and short-term price swings can make markets feel unpredictable, yet Pal argues that investors frequently lose sight of the bigger picture. Adoption continues, networks continue to grow, and over long enough periods, those trends tend to matter far more than short-term market fluctuations. His own experience serves as a reminder that being right about an asset isn't always enough. Many investors spend years searching for the next big opportunity, only to sabotage themselves once they find it. Fear during corrections, greed during rallies, and the constant temptation to chase whatever is currently outperforming can gradually erode what would otherwise have been exceptional returns. For Pal, the real challenge isn't identifying the trend, it's staying committed to it. That's why so much of his framework revolves around risk management rather than prediction. Avoid excessive leverage. Protect your assets. Focus on projects with demonstrable adoption. Keep a long-term perspective. And perhaps most importantly, recognize that volatility is not a flaw in this market, it's part of the process. The investors who survive are often the ones who learn to endure the discomfort that comes with holding through uncertainty. Whether you agree with every part of Pal's strategy or not, his central argument is difficult to ignore. The greatest returns in crypto have often gone not to the most active traders, but to the investors who were able to identify powerful long-term trends and then give those trends enough time to mature. In a market obsessed with finding the next catalyst, that may be one of the most valuable lessons of all. If you found this video valuable, please help support the channel by liking the video, subscribing if you haven't already, and sharing it with friends who are interested in Bitcoin and crypto investing. Thank you for watching, and we'll see you in the next video.